On this episode of The Capitalist Investor, we're going to talk about the Fed, inflation, and rate hikes nobody wants to talk about. The start of 2026, the Fed was expected to cut rates. Today, the Fed is expected to increase rates. And then as fresh inflation data is coming out, now we are back to status quo. So we're going to talk and dissect what we need to do, where this thing is breaking down, and what you should be doing about it with your portfolio.
So what do we got going on here?
All right, so there's where do you want to start? So let's just start in the beginning of the year. They were expecting rate cuts,
right?
And then that changed somewhere recently in the last month or two, especially with like the Iranian war going on and oil prices spiking and inflation starting to creep back up, that there were going to be rate hikes. Right, the rate hikes is going to make things more difficult to try and calm down growth and inflation, stuff like that. However, that changed recently with the most recent inflation data. CPI and PPI came way below expected numbers, and there was a 50% chance that we would have in June. It was a 50% chance that we would have rate hikes.
Right.
Maybe 2, if not 3, before the end of the year. It went to 5% that we have any. Like that's how drastic. That's how important this data was actually this week for inflation. So biggest things are that is where where hikes are going. But now we also throw in the mix that we have a whole new Fed chair,
right?
Kevin Warsh, and if you kind of read between the lines. Powell was more of a data dependent,
right.
and you kind of knew what was going to come down the pike with him. Like there was never many surprises, if any at all, with that guy, right? I think Kevin Warsh came out and said, we're no longer giving forward guidance, and I don't want to say play it by ear. Right. But he's like, hey, we're not going to give any forward guidance. We want to leave this very fluid because, everyone depends on it. Everyone starts, the stock market's a forward looking meximechanism.
Absolutely. Right? And I think that makes sense, too.
Right.
I think it really does.
Now, all right, let me ask you this question, though. Based on what I just said, if Warsh is going to be more cards to the chest, on Fed release day of what they're doing with rates can be a very volatile thing. If the market's pricing in no cuts and he cuts, or vice versa, or hikes, you're going to talk about some serious market movements, man. In my opinion.
So I agree with what you said there, but I think what just played out is why you don't need to have forward guidance for so long that people are depending on in the market, because it might not actually be correct.
Yeah.
I think that was my main point I was trying to make. It's too difficult. And, quite frankly, we saw the energy prices drop when the peak of the Iranian crisis, we got over that and the strait was open and all that stuff. And I know that is still very messy over there. But for this conversation and for inflation specifically, the oil prices and the energy prices were really what was driving that inflation up.
Yeah.
And it did seem very temporary, and it did seem like it was the main catalyst for doing that. So now that we got this data that basically just supports what I just said, that energy prices are plummeting versus where they were at, it makes sense to not have to hike rates 2 times in a row for the balance of the year.
Yeah. And I mean, but I can't say it's stripped off the table because, we did experience the high energy rates. It seemed like it was temporary. They're still a little bit elevated. But, let's talk about the things that are triggering inflation. So we got energy. We got AI infrastructure, and we still got services. So energy, that's pretty self-explanatory. When oil's not flowing, that's going to go up, right? And I heard another report that we're still at some of the lowest levels of our petroleum reserve. So that's alarming. It's down. I don't know how much they can actually hold, but they have like 300 million barrels or something like that. So that's and it's going to take a long time to reduce that up. But so something needs to happen with Iran. AI infrastructure, these massive build outs that is creating a lot of demand for just materials and construction and skilled labor,
This is
great. I mean, it's a good feeling. I don't know how long it's going to last, right? But I mean, I was talking to my one buddy. It's a company that we actually own. It's Quantum Services. So like they're A to Z construction company that really specializes on these data centers and power grids. They'll build a data center. They'll build the energy, the energy component. With all the transformers and stuff. They do everything. They basically even make everything from they fabricate everything needed for all the coils, all this stuff. They do everything. Construction. They got carpentry. They got electricians. They walk on the site and there's no sub. They're it.
Right.
Except maybe they go get their concrete from somebody else. But anyway, long story short, as I had this conversation, and my buddy's a pretty high up superintendent. He goes, their backlog of work is disgusting. Like he goes, we're gonna be busy. Real. We're gonna be busy for years. The backlog is just extensive. So
if you're an electrician, you're making like $250,000 a year on these giant data center projects. And I forgot who I was listening to talk. It might have been Kevin O'Leary. But they said that just in that sector alone, they need like an additional 70,000 electricians just for those projects. And it's just they can call the shots, man.
Oh, they're calling the shots on like how much that. Like, hey, if you need me, I need $50,000 more.
Yeah, if you want to build this data center, you got no choice. You're hiring those people. So the skilled labor, I think is great overall for the country. If my son or daughter was of college age, I would tell them to seriously consider those routes of those skilled electricians, things like that, because it's the future. It really is. It's job security. It is.
There was just a huge push to go to college. Right. I know when I was in high school, eons ago. God, I could, but 25 years ago. Man, it's 25 years. Maybe between 25 and 30. I don't know. Anyway, it's just a big push. Like, who wasn't going to college? Like that's what the trades and everything was left behind. Unfortunately. But hey, a resurgence in that is great. And then we also have services. Wage growth remains elevated on service sector, so that's keeping things sticky. It's keeping margins compressed and stuff like that. So. Again, the June inflation numbers came in, and they were supposed to be over 4, and they were 3.5. So that's a big deal. And the forecast, though, is inflation is going to be relatively steady. So in this like 3%, this 3 to 4% range for the foreseeable future. They're not expecting it to dip under 3 till almost 2028. So we might have these. I thought they were going to cut rates. I'm like, man, because one of the areas, and we'll talk about it here shortly, is like the housing sector.
Right.
We talked about it last week, but what a cluster.
Yeah.
And like housing and it's just it's so expensive right now, and there might not be any relief for quite some time. So unless they just start building more houses, and now you just flooded with supply.
I saw a meme when I was scrolling last night. It was like RIP to the real estate agents in 2022 who said you could just buy now and refinance in a couple of years. Because that ain't happening. And I think we have swings and misses, but we've been saying pretty much the same thing on inflation for really since 2021. Honestly, we never thought it was going to dip below 3%, and we thought a range between 3 and 4%. was going to be the new normal for a while.
Yeah.
And I think that's going to continue to play out.
Yep, I do too. And then because energy, I don't see energy going any lower anytime soon. Really. I mean, a couple barrel of oil and stuff could fluctuate back to 60. It could go back up to 100. Who knows, right? Couple bombs get tossed to each other, and the next thing you know, we got spiking inflation in the energy again. But the biggest thing is that I think the Fed, the new Fed chair, needs to be very careful because they don't want to repeat what happened in 2021.
Yep, exactly.
Some can argue that Powell hesitated too long and didn't increase rates fast enough, and that's why we saw near double-digit inflation, right? It was crept up to 9, right? And so I don't think we're in any type of situation like that where, supply chains are broken across the whole grid,
right.
From, energy and food. And I mean, everything was just broken because no one could go to work because they was, staying home and stuff, right? Work from home kind of stuff. But anyway, so I'm sure that's on the top of his mind. And, but they're, Warsh at the end of the day, his tone was like, hey, I'm not going to make decisions based on politics until he does. Anyway, sorry. I'm not pre-alluding that I feel that way, but I always thought that, the new Fed chair got the job because, Trump's like, hey, whoever gets in this thing, you should think
Start
about cutting rates immediately when you get in there.
Yep.
I thought that was the prereq to get the job. And it's just not being talked about right now. So we'll see. All right.
So what does it mean for retirees with the inflation and
Yep.
I think the
Well, let's do this.
Okay.
So there's hikes and there's cuts.
Right.
What happens when there's a cut? What think about, let's talk about, hey, the market was expecting cuts. What started happening? And when you start taking a look at the cuts, higher rates are bad for levered companies.
Right.
So if we start cutting and it's easier for people to borrow money or cheaper, levered companies should succeed.
Right.
When you start hiking, that is where these smaller companies are going to get really beat up because now it costs more to leverage their debt.
Yep. And we've kind of seen that, right? So over the last couple of years, we've kind of seen the value stocks outperform the growth stocks.
Yep.
And if we were expecting more rate hikes, that was probably a nice tailwind for those value stocks. Now that this new data came out and inflation might not be as hot as expected, and we might not have to increase rates, maybe we just stay the status quo for a while. That could maybe trigger a rotation back more towards the more growthy stocks, the more tech stocks.
Yep, exactly. And So the other thing is now with the bond market, if anything's going to happen, outside of the status quo, would be a rate hike is what I would really assume. And if there's hikes, that means we need to start taking a look at the bonds, and because it's a double-edged sword. Your asset will go down, but the interest rates will go up.
Right.
Now, if your asset goes up, one thing that you could start taking a look is that it can create paper losses, which could be good for tax loss harvesting.
Right.
Down the road. So, or towards the end of the year. I know that our investment team does that on a, towards the end of the year all the time. So in the last couple of years has been pretty, it's benefited, right?
Right.
People have to pay taxes. They're not happy about that, but we also want to take the paper gains and make them real gains. Yeah. That's the way I would describe that. Real estate's going to suffer. We just talked about that. But some of the other winners are going to be financial stocks. Particularly like well-capitalized regional banks, just because with higher rates, their margins go up.
Yeah,
if you got a 3% interest rate, where can they really go, right? But if your interest rates are 6 or 7, you can hide more spread in those numbers. Unfortunately, I don't want to say it that way, but how do you take advantage of that? You might be you might be on the bad end of of debt and things like that. But if you're not, how do you take advantage? Well, you invest in financial stocks. You start taking a look at they're already the financial numbers are coming out for earnings already, and everyone's doing well.
Yeah.
Everyone's doing really well. So think about J.P. Morgan Chase, Bank of America, Goldman Sachs. They're all going to do well. Because they have multiple arms of selling their businesses. They got their investment arms, they got their lending arms, and every one of them are doing fantastic.
Yep, for sure.
So,
I'll mention something here as well, since I always toss it in, but an increasing interest rate environment does make those annuity products more attractive. So I only bring that up again just because I've seen a couple clients recently that have just gotten their annual statements, and I'm not telling everyone to go out and buy annuities. Okay, you need to do that through a plan and a financial professional. But the ones that I was looking at recently, I saw like a 12% gain in 1 year on just a plain old growth annuity product. So as retirees are wanting to get more conservative in retirement, those can be good vehicles for them because there's a lot more upside with those products.
They're not designed to do that, to be honest, right?
Mm-hmm.
And when they do, man, you go take a victory lap because they're not designed. They're designed for mid-single digits at the most, like to act more like a bond.
Mm-hmm.
And then the cherry on top is that 12% is probably locked in forever.
Yeah,
right? You can't. Market can go down 20%. You still get to keep your 12.
Exactly.
So that's nice. Other things are like short term. So if you got cash, interest rates are going to be status quo if not increasing. Idle cash. Look for reoccurring monthly CDs. Schwab's got a money market paying near 4%. I do that with a lot of clients. Like, you can have access to your money. It's not locked up, and it's ultra liquid. T-bills, right? And then also think about this is that, as inflation is kind of, heaving left, right, up, down, things like that, we have to just make sure and understand that Social Security, the cost of living adjustment penalties, those are going to get helped as well, because if interest rates are going up, that means inflation's going up. So, and that could be good for your Social Security. It's just going to drain the trust fund a little faster.
Yeah. Not good for you and me.
Again, the Social Security thing, we can probably dig that up again. But man, I was talking about that in a presentation a week or two ago, and maybe we resurfaced that one of like what happens. Because they did change on the Social Security when that trust fund's supposed to run out of money. It went from 2033 to 32 now.
Right.
So again, not only are we getting closer to the number's getting closer to us. It continues to happen. So maybe we talk about that again in the near future.
Yeah, absolutely.
All right. So what do? We just talked about interest rate hikes, cuts, status quo. Basically, this is your checklist. Shift any excess cash from standard savings accounts earning virtually zero to short-term treasuries, money market funds. Again, I talked about the Schwab one, SWVXX. I mean, it pays somewhere between 3.5 and 4. It fluctuates on a day-to-day, but you can buy it today. It's active tomorrow. You can sell it today. It's liquid tomorrow, and so it's not like you're tying up your money, which is nice. Review your bond, your bonds, the duration, considering switching to maybe shorter stuff. And that's why, our team is doing what they're doing. Their investment team is, and that's what we see a lot of the short duration stuff right now. Assess your technology heavy concentrations. Sector rotation, away from growth it has been on its way. So if interest rates do go up, this could be, a headwind for these more leveraged companies is what I'll call them, away from growth and gravitate towards value. Mm-hmm. And then, thing is it's not a, I'm at 100 miles an hour, then 0, and then 100. This do not make drastic changes, right? Because again, the beginning, we're talking 6 months. We were supposed to cut rates, and then we're going to hike rates, and now we're not doing anything. And this happened within This happened within 6 months,
Yep.
right? 7 months, right? So just pump your brakes, don't make anything drastic. You can start rotating slowly, over the next few months, because who knows? Maybe next month's data is going to change because the price of fuel did catch up to inflation. So,
yep.
Any closing words on anything?
Yeah, I think the last point that you just hit was the one I wanted to make sure we hit on. We're just adjusting these things as we go. We don't need to be making giant swings either way. We don't need to be overreacting with the news. As we just talked about for the last 15 minutes, the news can change pretty quick. So make sure you got an overall strategy and plan. I see all these percentages on the internet too, especially when it comes to LeBron James. Like, these are just public markets, just like the percentages of people that think are going to hike rates or cut rates. It's not necessarily gospel that these things are going to happen.
Yeah, I mean, honestly, I think the path is nothing.
Right.
Because look how fast it changed. Unless something, I think, drastically changes, I think we're just stuck in our 3% plus or minus inflation. Like I said, 3 to 4. I don't think nothing's going to happen because they're still going to just wait for a trend, and a trend's probably 3 or more. Right. 3 or more consecutive, movements in inflation up or down. Because once inflation spikes next week, then they're going to be, oh, man, they're back to cuts.
Right, exactly.
But are they? Who knows?
So don't be whipsawing your portfolio around based on the news.
Yeah.
Stick to what you know, stick to your plan. Make sure you have your income planned out, and make adjustments along the way as more news and more information is available to you.
Yeah, I mean, it's probably the worst news of what I've read out of all of this is that inflation's here to stay. Like in this 3%, 3 to 4%, we ain't going to get below 3 for quite some time. And they're talking 2028, and man, a lot of things can happen literally overnight. Not we're talking 2 years away. Like, okay. So, all right, D, take us home.
All right. Well, thanks for listening this week. If you guys have any questions or comments, hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.